In August 2025, Chase Bank raised the monthly fee on its standard total checking account from $12 to $15. The threshold to waive that fee, a $1,500 daily balance or $500 in monthly direct deposits, did not change. For customers who cannot meet either condition, the account now costs $180 a year simply to maintain. There was no press release directed at those customers. There was no adjustment period. There was a new number, and there was silence. That fee structure exists inside a city that holds 384,000 millionaires, according to the Henley & Partners USA Wealth Report published in 2025. New York City has more millionaires than Shanghai, Chicago, and Toronto combined. It is also a city where, as of 2023, data released by the New York City Department of Consumer and Worker Protection. In September 2025, 238,900 households have no bank account at all. That is 7% of the city's population. In the Bronx, the unbanked rate reaches 13.5%. In Staten Island, it is 4.5%. The same municipal boundary, a 9 percentage point gap. The households most likely to be paying that $15 monthly fee. The ones who cannot sustain a $1,500 daily balance are, according to the same DCWP research, concentrated in predominantly Black and Latino neighborhoods with the highest poverty rates and the lowest median household incomes in the city. That is not an inference. That is the finding of a city government agency with access to granular neighborhood-level data. What follows is an account of how the American banking system operates in New York City across income levels, what it costs, what it provides, and what it withholds, depending on the balance a customer brings through the door. The Federal Reserve's 2022 Survey of Consumer Finances, published in October 2023, established that the median American checking account holds $2,800. The average is $16,891, a figure pulled upward by high balance accounts at the top of the distribution. The median is the more representative number, and it places most American households well below the thresholds required to avoid monthly fees at the country's largest banks. The average monthly checking fee at top U.S. banks is $13.95, according to a February 2025 Money Rate survey, with fees ranging from $0 to $20, depending on the institution and account type. The overdraft fee is where the cost of low-balance banking becomes most acute. In 2024, 11% of Americans paid at least one overdraft fee. The distribution of that 11% follows income almost precisely. Among households earning under $25,000 annually, 16% paid an overdraft fee. Among those earning between $25,000 and $49,000, a range that encompasses a substantial portion of New York City's working population, 19% paid one. Among households earning over $100,000, that figure drops to 6%. The fee itself averages around $35 and does not vary by income. The CFPB calculated what that fee represents in proportional terms. The average debit card overdraft covers a purchase of less than $26 and is repaid within 3 days. A $35 charge on a $26 purchase carried for 72 hours translates to an effective annual percentage rate of over 16,000%. For comparison, the payday lending industry, which has faced sustained federal and state regulatory scrutiny for predatory pricing, typically charges annual rates in the range of 300 to 400%. Overdraft fees, embedded in standard checking accounts at federally insured institutions, operate at rates that are orders of magnitude higher. The racial distribution of overdraft fees compounds the income pattern. According to Federal Reserve data from 2024, 21% of Black Americans paid an overdraft fee that year. 9% of white adults did. 16% of Hispanic Americans paid overdraft fees, compared to 6% of Asian adults. These disparities reflect underlying income and wealth gaps, but they also reflect disparities in access to banking infrastructure. In the Bronx, there are 1.7 bank or credit union branches for every pawn shop. In Manhattan, that ratio is 7.4 branches per pawn shop. The geography of financial services in New York City is not uniform, and the cost of navigating a sparse banking landscape falls on the residents of neighborhoods with the fewest options. Households earning under $30,000 a year pay an average of $31 per month in bank fees, according to a Bank Rate and Money survey. Americans at higher income levels, who can meet minimum balance requirements and avoid monthly maintenance charges, pay an average of $9 per month. The same banking system charges its lowest income customers more than 3 times what it charges higher-income customers, not because their accounts require more service, but because they cannot afford to hold the balances that unlock fee waivers. Chuck Bell, Advocacy Program Director at Consumer Reports, characterized the dynamic this way. Steep overdraft fees have long been a cash cow for banks that have enabled them to rake in billions of dollars in extra profits at the expense of consumers least able to afford it. The Consumer Financial Protection Bureau reached a parallel conclusion. In December 2024, the CFPB finalized a rule that would have reduced most overdraft fees from the industry norm of around $35 to $5. The agency projected that the rule would return $5 billion annually to American households. The rule was scheduled to take effect on October 1, 2025. In April 2025, the House of Representatives voted largely along party lines to overturn it. 22 state attorneys general filed opposition to that vote. Consumer advocacy organizations opposed it. The rule was repealed. The $35 fee remains the standard. The American Bankers Association, in opposing the CFPB rule, argued that the proposed fee cap was, in their words, directly at odds with the goal of regulators and banks to promote financial inclusion and reduce the number of unbanked and underbanked individuals, particularly for community banks with limited revenue sources. The argument, taken at face value, holds that the $35 overdraft fee functions as a mechanism for financial inclusion, that without it, banks serving low-income customers would lose revenue sufficient to justify continued service to those customers. Consumer advocates disputed that framing. The legislative outcome resolved the dispute in the industry's favor. Citibank's approach to tiered banking illustrates how major institutions have formalized the separation between customer segments. In August 2023, Citi overhauled its retail banking structure into 3 distinct tiers. Citi Priority, requiring a combined monthly balance of at least $30,000, Citigold, requiring $200,000, and Citigold Private Client, requiring $1 million. The restructuring was explicitly driven by the bank's objective to expand its wealth management business. To lead the effort, Citi hired Andy Sieg, who had previously served as president of Merrill Lynch Wealth Management. The Federal Reserve's survey found that the median American holds $8,000 across all transaction accounts. Citi Priority, the entry-level tier in Citi's affluent banking structure, begins at $30,000. For the majority of American households, that threshold is not reachable. Citi Priority is not a middle tier in any meaningful national sense. It is an entry point for households that already hold considerably more than the median. Citigold, at $200,000 in combined eligible balances, provides a materially different set of services. Fees on incoming and select outgoing wire transfers are waived. Non-Citi ATM charges are reimbursed without limit worldwide. Clients receive access to financial planning through Citi Personal Wealth Management. The account generates $200 annually in automatic statement credits applicable to subscription services, including Amazon Prime, Spotify, and TSA PreCheck enrollment. Citigold clients also receive what Citi calls the Culture Pass, complimentary admission to the New York Botanical Garden, the Guggenheim Museum, and the Museum of Modern Art. These are not marginal perquisites. They are substantive benefits, provided at no additional cost to customers whose account balances already place them in the upper range of American household wealth. Chase operates a comparable structure. Chase Private Client is available to customers maintaining an average daily balance of at least $150,000 across eligible Chase deposit and investment accounts. At that threshold, the fee profile changes completely. Monthly service fees are eliminated. Domestic and international wire transfers carry no charge. ATM fees at any machine anywhere in the world are waived, with refunds on fees charged by other banks' machines up to 5 times per month. Stop payment fees, bounced check fees, fees on money orders and cashier's checks, and exchange rate adjustment fees on international transactions are all removed. The account also provides $750 toward closing costs on mortgages and home equity lines of credit, and priority processing on loan applications with access to senior underwriting staff. Regular Chase customers, those on the total checking account, pay $3 per non-Chase ATM transaction in the United States, plus any additional fee the ATM owner imposes. In neighborhoods where Chase branch density is low, this is not an infrequent charge. It is a recurring cost applied to customers whose account activity would suggest they can least afford it. Chase describes private client membership as available by invitation. The practical reality is that customers approaching the $150,000 balance threshold can initiate the process directly by contacting their banker or through the bank's online platform. The invitation framing suggests exclusivity. The actual barrier is the asset requirement. Only 14% of Americans have savings of at least $100,000, according to a 2023 survey. Chase private clients' benefits are, in structural terms, inaccessible to the overwhelming majority of the bank's own customer base. Above $500,000 in investable assets, the nature of banking changes in ways that go beyond fee schedules and service tiers. Private banking at this level provides dedicated relationship managers whose scope extends beyond account management, coordinating event access, travel logistics, and introductions to professional networks. More significantly, it provides access to investment categories that are not available through retail banking channels at any price. Hedge funds in New York City generally require minimum investments between $1 million and $5 million. Private equity funds set minimums between $5 million and $25 million. Art and collectibles as a managed investment class typically begins at $500,000. These asset classes and the return profiles they carry are inaccessible to households below the relevant thresholds, not because of regulatory restriction in every case, but because the institutions offering them require minimums that most Americans will not accumulate in a lifetime. The Federal Reserve's data indicates that the wealthiest 0.1% of U.S. households hold approximately 1/4 of all U.S. equities. Access to investment products that generate compounding returns is itself distributed unequally, and the distribution aligns with asset thresholds set by financial institutions. The minimum to enter private banking at the largest institutions reflects the concentration of wealth at the top of the distribution. JPMorgan Private Bank, which traces its founding to 1799 and currently manages over $3.2 trillion in assets across more than 200 locations globally, requires a minimum of $10 million. In 2016, the bank doubled that threshold from $5 million, reportedly displacing existing clients who fell below the revised cutoff. Goldman Sachs Private Wealth Management sets its minimum at $10 million. Bank of America Private Bank requires $10 million. Citi Private Bank requires $10 million in investable assets and a net worth of at least $25 million. Management fees at these institutions are asset-based. JPMorgan and Chase charge between 0.50% and 1.25% annually, depending on portfolio size and composition. Goldman Sachs charges between 0.75% and 2.25%, at the higher end reflecting greater access to alternative investment structures. These percentages are applied to portfolios in the tens of millions. The absolute dollar cost of private banking management is itself a figure that exceeds the total wealth of most American households. In 2025, Bank of America launched what it calls the Alts Expanded Access Program, extending access to an expanded range of alternative investments. Eligibility is restricted to clients with a net worth of $50 million or more. In the same year, JPMorgan reorganized its private banking division to establish a new global head role, responding to demand from clients with $10 million or more, seeking to manage investments across multiple countries and asset classes simultaneously. The infrastructure the bank is building serves a client population measured in the thousands, in a city with a population of 8.3 million. The scale of wealth concentrated at the top of New York City's income distribution explains the institutional orientation. The 10 wealthiest New Yorkers collectively hold $400 to $21.6 billion, equivalent to 18.2% of the state of New York's entire gross domestic product, according to Oxfam's analysis of Forbes data published in March 2026. New York City is home to 154 billionaires whose combined net worth stands at $975.7 billion, according to a Fortune report from the same month. 1 in every 24 New Yorkers is a millionaire. The institutional attention directed at this population is rational from a revenue standpoint. Every product tier, every minimum balance requirement, every fee waiver offered at a higher threshold is calibrated to capture and retain clients whose assets generate the most fee income. The experience of the customer at the bottom of the fee schedule, paying $15 a month to maintain a checking account, absorbing $35 overdraft charges on small purchases, is the other side of that same calculus. New York simultaneously holds the 9th highest poverty rate of all 50 states. Roughly half of the city's rental households are cost-burdened, meaning they spend 30% or more of income on rent and utilities, a threshold defined by housing researchers as financially unsustainable over time. A 2026 YouGov survey found that 52% of Americans describe the wealth gap as a very big problem, and 59% said the government should take action to reduce it. The survey reflects public sentiment. The legislative record on overdraft fee regulation, finalized in 2024 and repealed in 2025, reflects a different set of priorities. 46% of American adults lack sufficient savings to cover 3 months of expenses. Among younger households, the fee burden is heaviest at precisely the point in life when savings are being built. 46% of Gen Z consumers and 42% of millennials pay monthly bank fees according to Bankrate's Checking Fees survey. That compares to 22% of Gen Xers and 14% of baby boomers. The cohorts with the least accumulated wealth are paying the most to maintain basic access to the financial system. The minimum balance to waive a monthly checking fee at Chase is $1,500, a figure that exceeds the total checking account balance of the median American household. The minimum balance to access Chase Private Client, with its full suite of fee eliminations, advisor relationships, and mortgage discounts, is $150,000. The minimum balance to enter Citigold, with its ATM reimbursements, wire fee waivers, and complimentary museum access, is $200,000. The minimum to enter Citi Private Client is $1 million. The minimum to access JPMorgan Private Bank is $10 million. These are not arbitrary numbers. They are a structured hierarchy built over decades, periodically revised upward, and defended through federal legislative channels when regulatory pressure has pushed in the other direction. The system charges the most to those with the least, waives fees for those who need the waivers least, and reserves its most comprehensive services for a population that represents a fraction of 1% of the city it operates in. That outcome is the product of deliberate institutional design, not market accident.